Hey, hello all. Hi, Kelvin here. Can anybody hear me or see my screen? So that I would appreciate someone actually type on the box before we get started. Good, good, good. Okay, great. So I believe that everyone is able to see my screen and able to hear me loud and clear. So we'll be starting pretty soon in about 2 minutes time. Yeah. Hey, hi all. I'm Kelvin here. Very good evening to all. Some of you all may have heard me speaking before in some of my CMC videos. So I'm very glad that today I'm able to share with you this very important and very interesting webinar. Is can the current commodities bull run continue? All right. So is there anyone who can't hear me or can't see my screen? Please do give me a shout out over at the chat box there. Yeah, good. So let's get started. Okay. Okay, so before we start, let's take a look at the disclaimer slides first. All right. Okay, good. Okay, so kind of a brief background of myself. I've been in the markets for close to about 15 years. Started off as a junior economist, forecasting more on the Asia FX rates before I branched out myself into the buy side, giving advisory and trading with hedge funds. So over the years, I started to actually branch out to global macro. Okay, what by global macro, that means taking a look at the broad-based asset classes like global stock indices, with an overlay in long short equity. And those who actually wanted to follow me on my tweets on the global markets, let's say that, for example, I tweeted very frequently, almost every day, Monday to Friday, on what's happening in the global markets. You can actually follow me at Kelvin SC Wong. Okay, this is my Twitter handle. All right, good. So before we talk about the kind of the outlook on the global commodity space, especially going forward to the next 3 to 6 months, and what other asset classes that can be impacted by the prices of the global commodities. Let's take a look at the scoreboard. Okay, so this scoreboard is a screenshot from Bloomberg. as at 10 of March 2021. So Bloomberg has a broad-based commodity index breakdown into various sub-indices: energy, petroleum, agriculture, grains, industrial, precious metal, and soft and livestock. So basically, all these are kind of a agriculture commodity, soft, livestock, grains. The industrial metals would be like copper, precious metals would be like silver, platinum, and gold. So if you look at the last 1 month of price action, okay, almost positive, except for grains, precious metals, but if you look at the longer time frame, from 3 months onward, 3 months, if you look at it, double-digit gain on the broad-based commodity prices, likely very, okay, I would say it's actually being driven primarily by the energy space. We talk about oil, up by 29%, the agriculture 20%. The one that is lagging would be precious metals. So as you know, that gold got hammered pretty badly, also not really that badly, but it actually underperformed against the broader commodity space in the last 1 month or so. All right, but for 1 year, almost everything is positive except for livestock, negative 3.12. Then you talk about year to date, almost everyone is positive, with the one that's highest return will be energy, 23%. All right, that is actually leading the outperformer commodity class within the commodity space. All right, so one that's underperforming will be definitely precious metals. Later I'll share the chart of gold. It's very, very interesting. And what do I see in gold in this coming next to 3 to 6 months time frame? All right, so net overall, what we could see now here is that the return, the current return that we see in the commodity space general is very positive. All right, so if you look at we talk about the current narrative so far that is driving this bullish run in commodities due to economy getting reopening soon because vaccination is here, global rollout. There is no what I call kind of a significant spike up in COVID-19 cases. Economy reopening up, there will be rush of pent-up demand that may start to come into the global economy in the next 3 to 6 months. That's driving commodity prices to actually see higher highs. All right. So now, the thing about commodities over here is that, and inflation, they kind of have a strong direct correlation. All right. So a lot of people say that, hey, inflation is not here yet. So commodity prices by right shouldn't be at this level. Okay. So if you look at the chart that can anyone hear me better now? All right. Yeah, so far it's quite clear. Okay, I try my best to adjust a bit. Yeah. Oh, all right. Okay, I'll try my best. Yeah, to adjust. Yeah. So, okay, what we are seeing right now here is if we look at the commodity space and inflation. So we are saying that inflation has a direct link with commodity prices. All right. So commodity prices over here is that it actually follows inflation. So there's a debate right now that inflation is still very, very low across the globe. So as you could see over here, this is the, I would say that the developed world, US, Japan, EU, UK, and Canada. If you look at all of the CPI numbers are still pointing downwards. Okay, lackluster since 3 years ago. Okay, since 20, in fact, not 3 years, since about 10 years ago, 2010. All right, from 2010 onwards. Okay, and if we were to look at over here in Asia, China, Hong Kong, Singapore, South Korea, and Taiwan, very similar as well. We have lackluster headline CPI as well since 2010. So this goes the debate over here is that even central bankers has been looking at, hey, CPI numbers is not that great yet. So what you see now is commodity prices, yes, they are pretty high right now, but it seems to me that there's not a kind of a proper direct correlation, or it could be due to speculation. As you know, that commodity prices is traded easily on the futures market. There could be rampant speculation that goes ahead of fundamentals. Yeah, possible if you look at the data from headline CPI data that I shared with you earlier on. But as you know that CPI data is, consumer price index is, I would say it's towards the end consumer. But what consumer consume is cost of goods. So we also need to look at services and goods, manufactured goods being produced by corporation. Will there be any pass down costs towards the end user, which is the consumer? All right. So let's take a look at expectation first. Okay. So if you look at expectation, we call it the 10-year break even. So what do people actually expect in the near future? What about inflation expectation? So inflation expectation, right, for US and Canada has started to inch higher since mid of last year. All right. If you look at Canada, one will be white. All right. US will be in blue. Okay. Then the green is actually the Fed equivalent, the US Fed equivalent of 10-year break-even inflation. Okay, being kind of calculated by their own research department. Okay, and now, like I said earlier, we got to take a look at how do prices fit into the CPI data. It comes from corporation first. That means we're talking about manufactured goods and services. If you look at one of the core country that tends to actually, most of us tends to actually, based on it's still right now, it's considered as a manufacturing powerhouse here globally. Perhaps maybe significantly it's not so we call it significant in now versus 5 years ago, but they still do have a significant production of global goods within China. Okay, if you look at China PPI, we talk about producer price inflation. That means we talk about factory gate prices. That means prices that comes up for China's factory rose 1.7% year on year in Feb 2021. All right. So if you look at it over here, is that it managed to actually break out a kind of a descending trendline resistance in place since 2016 over here. Okay, if you could see that I drew earlier on. All right. So in fact, factory prices has started to increase pretty significantly in China. All right. Then if you think of it, since most of our manufactured goods still comes from China in a way, also indirectly, that means going forward, CPI prices, there's a high chance that it will start to trickle down into a higher trajectory. All right, given that factory prices has started to increase, which means in the near future, producer corporation may start to actually increase their costs and services to us, the end user, which is the consumers. Okay, so one thing interesting is that you all can go to the research call. Which I like to actually go into this global PMI data compiler called IHS Markit. All right. Okay, this IHS Markit is over here. So IHS Markit global inflation, if you look at it over here, is that they break down according to input costs. If you look at it, global input costs, so it's talking about manufacturing costs, means producer costs. If you look at producer costs, it starts to actually shape a V-shaped recovery. Okay, a very V-shaped recovery compared to CPI. CPI is still lagging. Okay, so if you look at in the past since 2009, about 11 years ago, they actually moved it hand in hand. So in fact, right, potentially this input cost is actually a leading indicator. All right, it's a leading indicator that could actually tell us that, hey, consumer price index is actually may start to increase in the next few months. Okay, and if you look at the breakdown of the input costs over here, you look at also the prices charged. Then we talk about prices charged to end user. That means we're talking about business costs being charged to one another, as well as starts to increase as well, in line with input costs. All right. Okay. So so far the volume is clear, or is that, I mean, it's totally very soft or anything like that? Okay, so good. So volume is fine, yeah, very clear, good. So I'm not sure why some of y'all can't hear. Perhaps you could actually over and maybe perhaps you got to actually adjust your volume a bit. Okay, good, thank you. Okay, now take a look at manufacturing and services. All right. So manufacturing costs went up as well, together with services. Input costs, then their output costs also very significantly increases as well. So what it means going forward, there's a very high chance of higher selling prices of goods and services, which means, yes, even though we start to see very low or lackluster CPI data right now in the month of February, there's a high chance that going forward in the next 3 months, there will be a what I call positive feedback loop that's been triggered by this higher input costs to fit into potentially higher CPI in the next 3 to 6 months, which means it could actually support further what you call commodity prices on the upside potentially. Okay, so very quickly, if you break down according to country region, you could see that almost the major economy, except for Japan, which is still kind of lackluster, the rest like Eurozone, UK, US, the prices charge index has really increased as well. Talking about manufacturing costs. Similar for this developing countries, except for India, that is kind of lackluster. The rest, China, upward trajectory. We talk about Russia and as well as Brazil, all in a kind of a upward trajectory in terms of manufacturing input costs for both manufacturing and services, because this is composite consists of both manufacturing and services prices. That means talking about input costs for manufacturer providers and service providers has more or less increased significantly across the globe. Okay, with the exception of Japan and perhaps with the exception of India. Okay. Now, let's take a look at technically on the Bloomberg Commodity Index, because technical analysis is being my specialty. Since April low last year until 12th of March, the Bloomberg Commodity Index has really increased by 46 or 50%, okay, close to 50%, all right? So based on what we see over here, technically it has broken above this long-term circular descending trend line since July 2008. It's not a 1 year or 2 year trend line. It's close to more than 12 years. It's more than 10 years. About I would say that 12 years of descending trend line. And what we are seeing now is that there's a bullish divergence on the monthly RSI. It's not a daily RSI. It's a monthly RSI, indicating to us this long-term downtrend or circular downtrend more or less has ended, and upside momentum has started to come in with the break of this descending resistance on the RSI. Hasn't hit yet the overbought level. So potentially what we could see now, right, on this Bloomberg Commodity Index, technical elements are very bullish, supporting a further up move above 74.20, which is my long-term key support level, to actually go hit 104.50. A break above it could take us up to this level here, 121.75, 191/170 congestion, and the 61.8% retracement of the entire prior circular downtrend from the high of July 2008 to the low of April 2020. All right, so technically, it seems to us that momentum is still healthy. There's a change of circular downtrend that was previously in place since July 2008. And right now, we start to see a start of a major potential uptrend that still has room to actually maneuver to the upside based on this, my technical analysis on the Bloomberg Commodity Index. All right. So with that, right, So we know that commodity index broader base starts to increase as well. So let's look at the individual. Okay, what is a broad base? It consists of all the commodities like oil, precious metal, you have let's say copper. Okay, let's take a look at the individual asset class within the commodity index to see their key technical configuration. All right, so this one is copper cash. So copper cash, if you look at it right now, it's coming very close to the all-time high. The previous all-time high in Feb 2011 at 452.50/464.30. So what we are seeing now over here is that yes, the RSI is at the extreme overbought weekly. So what we could see potentially is a bit of sideways consolidation. There's no bearish divergence yet. Given by bearish divergence, if you look at over here, prior to here, right, you start to see the July peak 2018, prices go higher, but my RSI is sloping downwards. Okay, this is what I call a bearish divergence. That means this move here doesn't have any upside momentum to push it higher. But right now, what we are seeing here is similar high, no lower high. That means momentum is still pretty strong, except that it has reached a kind of an overstretch region, extreme overbought, where we could see a bit of consolidation between this between the all-time high region to this 379.80. So definitely key support will be at this 327.40. So why is this so important? Because it's the previous neckline resistance of this double bottom bullish breakout. Okay, so potentially, right, it could actually see much higher move heading towards 519.20 level, maximum 554.60 level on this copper. All right, so nothing pretty scary except for an extreme overbought move recently, perhaps more of a sideways movement first before the potential impulsive up move resumes for copper. All right, now one thing important over here is light crude oil. So as you know that light crude oil, or we talk about oil prices, is one of the significant drivers that actually drove, I would say that it actually contribute a significant higher percentage in this ongoing commodities bull run. As actually I shared with you on my earlier slides, which is the breakdown of the various commodities sub-index by Bloomberg. So what's interesting over here is that copper has really, part of the copper, light crude oil futures has broken up from this July 2008 circular descending trend line. Okay, that's about 12 years of 30 years of descending trend line. So what we could see over here is that the pullback support of this trend line is at 63, key support 50.60, looking for a further push up to test 75.70, followed by 87 level. RSI, there's a bullish divergence prior to that. All right, over here, lower low, higher low. The monthly RSI has yet to hit the extreme overbought level at 79. So potentially you could see further potential upside to test 75.70, followed by 87. Okay. Okay, great. Now let's look at gold. Before I talk about gold over here, right? Recently, there's this narrative that because there's an increase in the US 10-year real yield. Okay, so what is a real yield? Real yield is basically your US 10-year yield minus off a CPI inflation number, like your core CPI. Okay, so this line here, the right line is your US 10-year yield. Since the start of the year, it starts to go up. So there's a kind of narrative saying that, hey, if there's a increase in this US 10-year real yield, gold prices will tend to actually be on the downside. Why? Because you know that if you hold gold, the way we're talking about, you buy and hold gold, it don't give you any income. Income as in, we talk about interest income, because gold itself is a zero income interest producing asset. It's not like a stock. Stock potentially it could give you dividend. All right, or if you buy corporate bonds, you get coupon rate, the coupon payment every 1 or 3 months, depending on the corporate bond terms and conditions. But for gold, it doesn't. So the term about gold over here is that the only way gold can give you income is capital appreciation. So there's this narrative saying that, hey, if US 10-year real yield increases, that means we're talking about potentially your bank interest rate or your fixed income interest rate or interest coupon may increase as well. Okay, so in order to test this relationship, whether does it hold, right? We could do a kind of a correlation analysis. So if I plot this correlation analysis since 1965, talk about very, very long term. If you look at the correlation, right, it's only negative 0.38, not very strong. Okay, because if you are talking about if you have a very strong correlation coefficient for this narrative to hold, that means if US 10 real yield increases, gold prices will start to fall, then your correlation coefficient should be close to about negative 0.7 to negative 0.9. Okay, so maximum it can go is negative 1, which is a perfect correlation inversely. So if you base on this longer term correlation analysis, it seems to me that this narrative is not strong if you take into longer data into consideration. So based on what we are seeing over here on this data, it could be that the current narrative where US 10-year real yield increases, it will actually pressure gold prices. Yes, perhaps maybe on the shorter term, but on the longer term, this correlation coefficient doesn't seem to be quite strong based on the reading of negative 0.38. Now, technically, let's look at the gold price. This based on our platform, Gold Cash. So what's so interesting over here is that if you look at last week price, it actually managed to bounce off a key inflection point, 167, 1670/40. So basically, why do I define this as a key inflection point? Because graphically, there's a graphical support at this area. Mathematical is the 100-week moving average. And this descending trend, descending ascending support level. Fibonacci projection from the recent down move over here, taking from the high to the low, project from here, it gives you one time. And if you look at the entire major uptrend since August 2008, project up to the current all-time high, August 2020, is at a 50% retracement. So we have a couple of different elements that is just pointing this level, 1670/40, as a key inflection level or key support that we may start to see a potential recovery. All right. So those who knows about idiot wave, it could be the wave 4. Okay, we're talking about 1, 2, 3, wave 4, corrective move. It may have ended, but at least it could start to go up towards 1965, maximum 2075. Okay, depending, let's say if it's a what I call a 535 flat consolidation. RSI at a significant support level as well, which is also about 38 level. Okay, so technically what we could see over here is that gold has really come to a very interesting inflection level at 1670/40, which may start to see a bit of recovery at this juncture. Okay, based from a technical analysis perspective. And also, we're talking about the correlation with the US 10-year real yield. It seems to be very weak if you take it to more data, longer term data perspective. All right. Now, so if you look at step by step, right, commodity prices technically across the board seems to be has what I call further upside potential. Fundamentally, it's also supported by higher global PMI input costs and PMI charge prices. That means we're talking about corporation start to charge one another at a higher cost, and also the goods that they start to produce also seems to be that it starts to inch up higher as well, which could have a trigger down effect to actually see further upside pressure in the next potential 3 to 6 months on our headline CPI numbers. All right, so all in all, fundamentally and technically, it kinds of support further potential commodity prices. All right, so right now with further commodity prices over here, so what could be some interesting asset prices that can outperform? All right, So we're talking about, let's talk about stocks first. Okay, so we know that definitely energy stocks. Okay, energy stocks tends to actually be the one that is beneficiary right now. So if you look at across the board, like US, the S&P sectors, XELE, the energy sector has been outperforming since the start of this year, okay, versus growth stocks, all right? But we know that these stocks have really run out. Okay, what is the next stocks that we could watch? Okay, so potentially we could actually look at commodities traders. Okay, what are commodity traders? Commodity traders are involved in the business of trading commodity prices. So they do have a kind of a co-relationship where higher commodity prices actually supports the share price of these commodity traders. So very interestingly, right, if you look at one of the commodities traders that I'm looking at, these agriculture traders, Bunge, BG in short, is based in US. What's so interesting is that this is a weekly chart. You look at recently in the last 3 weeks or 4 weeks or so, it has started to shape a bullish breakout from this long-term descending circular range since 2015. All right, with the 20-week MA now supporting it at 71.50. Also the pullback of this, we call it a former descending range resistance, now turns to pullback support. Okay, so potential what we could see is that it could actually shape a further up move to test the November 2015 high, 9280. A break above it could actually give a retest to its current all-time high that was printed much earlier on in Jan 2008, which is at 125.50, 1/135 level. Okay, so pretty interesting and positive technical configuration on this particular US-based agriculture trader. Okay, the next one is actually Glencore. So I believe most of the time we have heard Glencore. So Glencore previously we talk about when they IPO somewhere around in 2011, that is their all-time high. If that ever since then the prices starts to come down, keep coming down, because we're talking about since we talk about 10 years ago, commodity prices has been pretty depressed on the downside. That could actually give downside pressure in terms of profit margin for such, we call it commodities traders. So very interestingly, what we see right now, right, is actually start to inch up, and in fact, since September 2015 to March 2020, it starts to shape this kind of impending major bullish double bottom configuration. All right, so what we could see over here is that I have 186.50 as my key support level over here. The previous range top broke out test, and right now potentially for the next 3 to 6 months we could actually see retest the neckline of this double bottom configuration at 400 pence. This pence, of course, is UK. Okay, so it's actually a commodity. It almost has business interest in almost all the various commodity asset classes, from base metal talk about copper, energy, as well as agriculture. Okay, except I don't think they have any business dealing with precious metals. Okay, now the next one, let's deal with more on the base metal, iron ore, coal, copper miner, is BHP Group. So BHP Group, pretty similar as well, also break out from this very long-term descending range resistance, which is May 2008. So that was the prior all-time high. Okay, so right now, the pullback of this resistance right now is at 41.25. So that would be my key support, allowing it potentially to shape further potential up move to actually test this FIBO expansion cluster level at 59/60.30. All right, this RSI, monthly RSI, is still positive, hasn't reached the extreme overbought level yet at 78/85. No clear signs of a bearish divergence as well. All right, the next one closer to our shore will be Wilmar, a Singapore-based, this purely agriculture. Here's our agriculture trader. So if you look at September 2015 to March 2020, this is the low, 2.83 to of March. So it starts to shape this kind of major rounding bottom as well. Okay, broke out from this rounding bottom last, in fact, yeah, late last year. All right, so right now it's trading kind of a at this median line of this ascending channel at 5.2. Okay, so definitely my key support level will be 4.8. Okay, the previous high broken up down, turns into a pullback support. Also the support of this ascending channel from 23rd of March 2020 low. Looking for it to test the top of the channel right now at $6.12/60, and followed by a break above it should take us up to the September 2009, April 2010 previous swing high. Also correspond to this FIBO expansion cluster level at one time level, okay, which is also confluence at $6.8/$7 level. So all in all, what we could see is that the price action of Wilmar, similar to other commodity-based trader that I shared with you all, also shaping this kind of rounding bottom as well, similar to Glencore, that Bungie and BHP has been broken out of their descending range resistance. Okay, so what we could see is that a lot of this major commodity-based trader are actually shaping this kind of potential bullish configuration on their technical chart. So this gives me a kind of a very interesting observation. Hey, within this bullish commodity play that is unfolding in our eyes right now, the next potential, we call it play that we can look at is all this commodity-based trader that we could actually keep a lookout for in the next 3 to 6 months. All right, since the prices have really just started to move up. Okay, now the next one will be this. It's a producer instead. This is EOG Resources based in US. All right, so this EOG Resources, right? What's interesting over here is, yes, we have this breakout from 9 October 2018, previous descending resistance. And what interesting over here is that it has started to weekly close, which is 2 weeks ago, above this previous long-term circular pullback resistance since Feb 2009. Okay, very significant. It has a punch up above it. So what we could see is a kind of a double bottom bullish breakout. Over here, the neckline of this double bottom will be at 59.20. RSI still positive configuration, hasn't hit an extreme overbought level at 80. No signs of a bearish divergence. Okay, what about bearish divergence? If you look at previous over here, this all-time high at October 2018, we start to see higher high, higher high, higher high, but your RSI is shipping lower high at this point in time. So we do not start to see such configuration over here versus this point. So what it means that the longer term upside momentum is still pretty intact. So what I could see potentially, it could actually keep further potential to actually test this next resistance at 8850/9280 before a break above it could take us up higher towards the 76.4 FIBO retracement from the all-time high of October 2018 to the 18th of March 2020 low, which actually confluence with this swing high as well at 102/104, 108.40. Okay, and also the 2 times FIBO expansion level. All right. Now, so these are the various, we call it equity related commodities that we can actually keep a close watch on in the next 3 to 6 months. All right. So now moving on, given such we call it further potential move in commodity prices, it could actually impact other asset classes. Okay, equities are already covered already. How about FX? Okay, so for FX, right, one of the very sensitive pair that actually move in line with crude oil prices or oil prices will be the Canada dollar. Okay, let's take a look at this chart. So what I did is that I actually plotted USD per CAD. That means we're talking about CAD as a base currency. 1 CAD equals to how many USD, which is the inverse of dollar CAD. Okay, most of the time we trade FX, dollar CAD is the primary, the way how it code means 1 USD equals to how many CAD. But in order to see this correlation much easier, I inverse it to actually make CAD as a base currency. So if you look at this is a long-term chart since more than 10 years, since 2016. CAD USD actually move almost hand in hand or in direct lockstep with light crude oil prices. That means, i.e., if light crude oil futures or oil prices goes up, Canada dollar goes up. If light crude oil prices comes down, Canada dollar will also depreciate against the USD. So if you look at the correlation over here, coefficient between Canada dollar or CAD USD and crude oil is positive, and it has a very high positive level at 0.9. Okay, since 2020, that means the whole of last year until currently in the first 3 months of 2021. So what it means that earlier on, I shared with you all that technically light crude oil prices could potentially go much higher, technically to about the 70, 75 level mark over here. That means it tends to actually support further potential up move in Canada. That means Canada CAD dollar will have the potential to actually appreciate against the USD. Okay, pretty clear. So now let's take a look at the chart of dollar CAD. This is how they conventionally was our dollar versus CAD. Yeah, so dollar CAD chart is actually showing that kind of element as well, that is supporting further appreciation of the Canada dollar. So this is a long-term chart. It's a monthly chart, not hourly chart or weekly chart. It has a very important significance in the longer term. That means going forward in the next 3 to 6 months. All right. So if you look at since 20 November 2007 at the low of 90.57, dollar CAD has been bouncing up to reach a high of 46.70/90 March 2020. Hit this level, can't go above, and it came down. Okay, and where it stopped, right? It actually stopped exactly at the 76.4% retracement of the previous bearish downtrend. 5 years of downtrend from January 2002 to November 2007. All right, and also the one-time Fibo projection from the low to the high, project from the year low, okay, is 1.236. Okay, not 1.236. So we have a Fibo confluence level, confluence with a graphical resistance, and right now, if you look at it right now, the way it starts to trace out is a impending bearish double top. Okay, with the neckline support at 1.2070. Okay, now it's about trading at 24.84. Okay, this is based on 16th of March price. Okay, it hasn't really moved much yet. So what we could see here is that definitely this is a key support level. A break below could test below the next support here, and definitely this will be the key support at 1.0660, which is also the ascending trend line that managed to cap previous decline since 2007. Okay, now let's look at the weekly chart. We go down to a lower time frame. So on the weekly chart, right, what we see here from the March 2020 high all the way down to the current price level is a bit overstretched on the downside, as represented by the RSI coming close to the extreme oversold level, where we could see a kind of a medium-term rebound. So potentially what we could see now is there could be a test at this 2017 neckline, a bit of bounce back into this zone here, which is the pullback resistance of this former ascending support level. And also if you use the Fibonacci retracement, it's close to 50% from the high, from the March 2020 high to here, okay, to the current whatever, to the current low. Okay, then thereafter it could actually shape another down leg to actually test the next support level at 1.1220. Okay, so all in all, right, the technical configuration of dollar CAD is still inching towards more on the downside rather than a potential bullish reversal. But we know that prices don't go in one vertical line down or vertical line up, because this move down here is a bit overstretched really since the March 2020. So what we could see is that perhaps a bit of rebound at this 2017 neckline support before another down leg materializes potentially for dollar CAD. All right. So now I've covered we call it asset classes that could potentially have positive feedback loop on the potential further rise in commodity prices in the next 3 to 6 months. So what other asset classes, right, or what other instrument that will have a negative feedback loop? That means, i.e., we're talking about if commodity prices going to go up higher, what other asset classes will move inversely with commodity prices? That means asset classes that will drop instead will go up in line with the potential further up move in commodity prices in the next 3 to 6 months. All right, now if we look at the movement of Zoom video communication, all right, so Zoom video communication is part of the growth story stocks. So if you look at it, right, before we talk about fundamental linkage first, we look at the chart. Okay, let's look at this chart of Zoom. So very interestingly, right, since the start of this year or late last year, the price action of Zoom has started to come down, whereas like crude oil prices keep on going up. And this is the commodity index tracking fund, DBC. So your DBC, right, is something very similar to your Bloomberg commodity index, except that it's an ETF that can be traded over at the New York Stock Exchange. Has been going up. So what you see right now is that if I plot the correlation coefficient of Zoom versus LCO, like crude oil, and versus DPC, which is a kind of a ETF that's tracking the broad-based commodity index, similar to the Bloomberg commodity index, except that this index is tradable over, it's an ETF that is listed on the New York Stock Exchange, is that it started to show this kind of negative inverse relationship, pretty, I would say pretty high, negative 0.6, negative 0.6. So what it means that commodity prices like oil or the border-based commodity index starts to increase, the movement of Zoom has started to be on the downside trajectory, all right, based on the price action. So now, fundamentally, why does this actually occur? Okay, don't forget, initially, Zoom video communication actually thrive on lockdown. We're talking about the last 1 year. If you look at since March, you see a strong uptrend. So the thing about this is because we start to see the COVID-19 scare where there is a risk that, hey, there will be potentially lockdown, where people will start to not to come to office, will start to use more video communication to communicate in their daily life. And even so, they have a narrative that, hey, after, even though COVID-19 has ended, post-COVID-19 world, people will still start to use this kind of work from home narrative. Okay, but it seems to be that right now is that this narrative starts to change. Now we're talking about pent-up demand coming back into the picture. People eager to start to get out of their home, especially in the Western world, where vaccination rollout has starts to increase significantly, especially in the US. So that could actually hamper the growth of Zoom fundamentally. So this can actually explain the reason why we start to see such significant direct or inverse correlation where I plotted Zoom versus the price action of crude oil futures and as well as the commodity index tracking fund. So what we could see over here is that technically, based on this correlation study over here, is that if we expect further commodity prices in the next 3 to 6 months, that means, i.e., it potentially could translate to a negative feedback loop because it moved inversely on the share price of Zoom video. All right, so now let's take a look at the technical chart of Zoom video. All right, so this is a weekly chart. So if you could see since the high of October 2020 over here, it's now started to evolve in this kind of descending channel. And if you look at the weekly RSI, it's also pretty negative right now. Why? Because it broke from this previous support, tested it, and right now it starts to inch downward below the 50 level mark. So what it means that based on this RSI observation, is indicating to us that the downside momentum is still pretty intact. There is no clear sign of bullish reversal coming into place yet for Zoom. Okay, this is based on the price of 16th of March, not too long ago. That means what we could see that potentially, if this medium-term pivotal resistance that I have doesn't break, which is this former swing high here, also below this 20 week moving average at 398.70, key medium-term pivotal resistance 443.70, it could actually potentially see further down move within this descending channel to test 255.40/240.40, which is this former swing low here in July to August last year, and also the 61.8 feeble retracement of this entire 1 year of up move since October 2019 to the high of October 2020. All right, the 76% feeble retracement is at 194.85/184.60, which is also the one-time feeble expansion level of this down move over here, corresponding to the this lower boundary of this descending channel. So all in all, right, what we could actually see for Zoom technically, right, I do not see a clear sign of a bullish reversal yet, potentially given the current price action. So as long as 44.370 resistance is not surpassed to the upside, the risk of Zoom is still more skewed towards the downside, towards the 255/240.40 level. So that could actually be impacted by what I call higher commodity prices, which actually translate to going forward, we start to see economic growth starts to improve, especially in those countries that was previously hit pretty badly during the COVID-19 pandemic. So it kind of shift this kind of negative feedback loop into Zoom video, which is kind of also part of this tech and growth, we call it a sector. All right, so with that, right, I kind of covered almost all the key charts that we should be paying close attention to in the next 3 to 6 months. Yes, based on the technical chart I shared with you all, I do see potentially commodity prices tend to potentially have further potential upside in the next 3 to 6 months. And how do we actually play this potential move is that we could look at the various commodities traders that I shared with you all, together with one US-based resources producer, which is EOG. And on the FX space, we could actually look at dollar CAD because based on the correlation chart, CAD should actually appreciate against the USD based on its very close, significant direct correlation with oil prices. And also one particular stock that could actually be inversely impacted or negatively impacted by this highly potential further rise in commodity prices will be Zoom Video, which is part of this tech and growth stocks team play that could actually see a bit of potentially see further underperformance in the next 3 to 6 months. All right, so I will come to this end of my presentation over here. So right now it's Q&A session. I have a bit of time right now left, 10 minutes. So do feel free to ask me any question in the chat box over here, and I hope that I could actually share to answer as much as possible. Okay. Firstly, somebody asked me about gold. Okay, let me touch on gold first because I think previously I did cover, I did show a chart of gold. Let me go back over here. Okay, so this is a chart of gold. All right, so for gold over here is what's interesting for gold is technically it has come to a key inflection level at 1670/40. Explained earlier on is graphically congestion, mathematically the 100-week MA and this ascending trendline support. And what we are seeing right now here is this potential could be the end of that wave 4 based on index wave 4. So what we could see now is potentially we could see at least a recovery towards 1965 in first step. Then thereafter we should go up to test the current all-time high at 2075 on gold price. All right. So it's very interesting to see how it actually evolved in the next I would say 1 to 3 weeks at this juncture. All right, but definitely this is a very interesting key inflection or support level that I'm watching very closely. Also correspond to this RSI bouncing off from a key significant support level at around this 38 level mark as well. All right, so then okay, for silver, okay, silver right now I do not have a chart of silver with me right now, but nevertheless I could share it tomorrow. I'll post it in my Twitter handle on my weekly outlook on gold and the key levels to watch. All right, Ken. Another question, which commodity ETF would you recommend we look at? Okay, so for commodity ETF, we can take a look at, it's listed on our platform, we do have it on our platform as well. All right, this one, DBC, Invesco DB Commodity Index Tracking Fund. Okay, that is the broad-based commodity ETF. All right. Okay, so another question is this. Okay, let me go through. Okay, if growth stock weaker, will it affect S&P and Nasdaq Comp? Okay, this particular, yes, definitely. So to me, right, what I see right now is for those who kind of follow my weekly outlook, or because I do cover a weekly outlook of the S&P 500 and Nasdaq, I also write about my thoughts on my Twitter handle on this situation between the rotation of value towards growth. So as you all know that why growth stock weaker, the narrative is because of the US rising 10-year yield. Okay, so everybody was pretty scared when the US 10-year yield went up to 1.6, 1.6, which was 2 weeks ago. Then from there, you start to see growth stock weaken. All right, become pretty significantly, especially on the Nasdaq and the S&P, because both of them are kind of heavily weighted towards the FANG stocks. So biggest component weight on S&P is still Microsoft, Apple. Then Nasdaq will be definitely your Amazon, Apple, and Microsoft. All right. So right now is that one thing positive that I see over here since the start of, if I'm not the start of it, on Friday. So if you look at last Friday, right, the US 10-year yield actually surpassed the 1.6 level, which was the high was seen 2 weeks ago. But what do we see over here? We do not see a kind of escalation or a kind of steep sell-off on the Nasdaq 100. So in fact, for last week, the Nasdaq 100 index actually has a weekly gain of 2% plus, which actually managed to step or pause the previous 3 weeks of consecutive decline. So that's one thing very positive. So what we are seeing right now, right, is this kind of place that, hey, market starts to be more comfortable with this pace of rising US Treasury yield. But the key thing over here is that I still see that, yes, even though Nasdaq Comp or S&P 500 is more or less kind of stabilized from now, especially for Nasdaq 100, which is Nasdaq Comp, potentially we could see more sideways movement from here. That means for them making new higher high or new fresh all-time high, the probability tends to be pretty much slim. Whereas you start to see, we talk about Dow Jones. Dow Jones potentially could make new high. S&P, yes, S&P we can still make new high because S&P itself, we still have other weightage in like the financials and other cyclical and value-weighted stocks. Yeah, so I could still, from the technical perspective, I still expect yes, all of them are still pretty much healthy in terms of we're talking about circular uptrend and medium-term major uptrend still pretty much intact, except for the Nasdaq 100 and Nasdaq Comp. It will be a bit tricky over here, more sideways movement. I cannot expect them to do lower lows. That means breaking below 2 weeks ago low. Why? Because we talk about everything move hand in hand. We cannot have a situation where Nasdaq 100 or Nasdaq Comp start to shape a bearish downtrend in the medium term or in the major term, not longer term picture, whereas the rest of the major US indices, the rest of the world keep going up. So all in all, right, they got to be hand in hand. Okay, so someone asked me Nasdaq 100 chart. Okay, good. Okay, let me very quickly touch on Nasdaq 100. Okay, very quickly. It's away from the topic that we are discussing today. This topic is talking about commodity prices. Okay, so let me share. Okay, can you all see my CMC platform now? Yes, no? Okay, good. Okay, let me switch on to my index. All right, so for those who wants to hear more about my weekly outlook, don't go to our CMC channel, YouTube channel, because every Monday I publish a weekly outlook on the major indices. That means I touch on Nasdaq 100, S&P, German DAX, Nikkei 225, and Hong Kong 50. So every Monday I'll publish it between 2 to 3 p.m. on CMC Singapore YouTube channel. So you can actually take a look at that. All right. Okay, so now firstly, let me touch on this first. Okay, so This is Nasdaq 100. Okay, so if you look at Nasdaq 100, right? Okay, this is my long-term trajectory. Okay, this is what I have previously in my quarterly outlook. So what we call this, see this Nasdaq 100, right, is that right now it's a bit kind of concern is number one. If you look at, it started to shape this bearish divergence, higher high, lower high. Okay, so what we could see right now, right, we could see a bit of sideways movement. Okay, around this current all-time high, 1385. Okay, so where's the support level? So if you look at the current support level, we definitely this line here. Okay, this particular line here. So what we could see, right, a bit of sideways movement for the Nasdaq 100. It's still technically it's a bit weaker based on this bearish divergence. So what we could see, right, for on the daily chart, this is what we're having on Nasdaq. So you realize that 13,340 is a kind of intermediate resistance. The support level coming at 11,770, which is the 200-day moving average. Okay, so what we could see right now, right, for this Nasdaq 100, it could start to churn, right, in the next multi-week between this upper boundary and lower boundary, 13,340, 12,180. Okay, so far so good, clear. All right, so for Nasdaq 100, right, I still expect to underperform versus the other major US indices. So very quickly, let's take a look at the S&P. Okay, so if you look at the S&P, right, we start from a longer term chart. Okay, this is the daily chart, shaping higher high. Now testing the previous all-time high as the 3960 level. Okay, the 4-hour chart. Okay, right now it's trying to shape a pullback. Okay, after a test of this all-time high, previous all-time high here. Okay, so potentially it could still shape higher high on the S&P. All right, so I'm still expecting kind of underperformance on the Nasdaq, but Nasdaq 100 cannot keep, it's more sideways rather than shaping, I would say lower low, means lower low than the previous 2 weeks low, because like I said earlier, all of them got to move hand in hand. That means we cannot see a Nasdaq 100 that started to crash on the downside, whilst the S&P starts to move up. So what we could see right now is a rotation play where previous nuggets, cyclicals value has now started to outperform. So once this outperformance has really moved its end game, we talk about end game. So everything has started to rotate really. If you recall, energy has been the underperformer since the last 9 to 10 years. So after all this play has been really started to fulfill its potential, this is where potentially we will start to see a major stock market crash. That means we're talking about a major retracement that retraced the long-term circular uptrend since March 2009. We're talking about close to 10 years. There hasn't been a significant retracement yet. So until that rotation play completes itself, so how long will it last? Well, that's a very golden question that everyone tries to answer. So if I were to look at its relation with commodity prices potentially could still see further potential upside, technically 3 to 6 months. So give or take, I would say on a very conservative estimate, perhaps this cyclical and value rotation can last for another 3 to 6 months. Then thereafter, we got to be a bit more cautious on how does the central bank provide us with further guidance. Because at the end of the day, inflation will start to come in. So once inflation starts to come in, this is where we will start to see a tightening monetary condition. That means the central bank, right now, they got to face a very tough choice to make. Do I want to rescue the real economy from inflationary pressure, or do I want to rescue the asset classes? That means we're talking about financial markets to prevent a major risk of impact that could actually create a demand shock. So that will be a very kind of a challenging and interesting moment that we got to observe in the next 3 to 6 months down the road, the time frame. All right. Okay. So I hope that I'm able to answer your question. Okay. So one S&P is okay. So I want to share with you, okay, S&P 500. Yes, for the S&P 500, right? We are talking about is 500 companies. 500 companies are the top 5 or 3 is still under FANG. All right, it's still under FANG. But the bottom 300, if you add all together, it still has a significant potential on the cyclicals and value. Okay, what do I mean by this? Okay, so let me share with you a particular chart, right? Or kind of a okay, so this website is free. Okay, so if you go to this S&P, okay, it gives you the component weightage. So if you add up Apple, Microsoft, Amazon, it's only 13% of the S&P. Okay, then plus you talk about give or take 15 or 16. Okay, together with Tesla, all this. But if you look at all the banks together, if you add up the rest, Disney, Visa, all this, if you add all this together, it could actually be more than these banks over here, together with Tesla. Can see that? Yeah, I hope that answer your question. Even though S&P, yes, is weighted according the top 6 or 7 is the FANGs and growth, but their weightage add up is only close about 13 or 16%. Whereas the remaining 400 plus, if you add them all together, that could actually surpass their weightage as a whole. Great. Okay, so why do I choose Zoom instead of all growth stock? Because Zoom give me a better technical configuration that I could share because of the descending channel. All right, so that's how I select Zoom based on my experience with the technical configuration that I see on Zoom. All right, great. So so with that, right, I think I've come towards the end. Yeah, it's 8:06 already. So I think someone asked me about NIO. Okay, so I'll try to post a chart on NIO on my Twitter tomorrow, my Twitter handle tomorrow, about what are the key levels to watch for NIO. All right, great. Yeah, so I hope that I answered your question. So far, so good. Thank you for your time, and I see you all again in my next webinar. Thank you very much. Oh, before I go, what is my Twitter handle? Okay, so for my Twitter, okay, so let me go on to my page again now. Okay, so you can follow me here, Twitter at Kelvin SC Wong. So that's my Twitter handle. So once you set up Twitter account, you search for me at Kelvin SC Wong, and you're able to just click on follow. Then you're able to follow my tweets on a daily basis on the markets. All right, great. So thank you for your time and have a great evening. And I'll see you all next in my next webinar. Thank you.